Hello everyone. Today is the 2nd of August 2026 and this is episode number 88 of Just Dario Cigar Time. In the first part of today's episode, I will provide a crucial update on the crude market to help you understand what's likely to happen in the coming weeks. In the second part, I will touch upon Japan and the now unfolding crisis surrounding the Japanese yen. Finally, in the third part, I will share my views on this week's events in the AI stocks space. Before we begin, if you like my content and want to support my channel, don't forget to like the video, subscribe, and turn on the notifications so you don't miss any of my future updates. To understand the crude oil market situation, we must start with what happened at the end of the trading week. After regular trading hours stopped, 4 p.m. Eastern Times, crude oil futures suddenly shoot up by $4, with the WTI closing the week at around $87 a barrel. This move caught most traders by surprise, as they were already having happy hour, enjoying their drinks and canapes. Over the first months, I have discussed the mechanics of crude oil market manipulation extensively. I don't think there is any need to spend more time on that today, especially considering what happened this week, when the manipulation continued, and at some point they didn't even bother fabricating headlines to cover it up anymore. Their goal was to keep a lid on prices, while the supply chain crisis worsened in the real world. This worsening was certified by the latest EIA report on Wednesday. Not only the EIA report was a massive draw of 11 million barrels of crude oil inventories in the US, but they especially reported a significant 700,000 barrel draw in Cushing, Oklahoma inventories. Those inventories are now at 18.6 million barrels, very close to the critical operational minimum, and already within the tech bottom's danger zone. If that minimum is breached, the facility will not remain fully operational. Now combine this information with the move that shocked markets the very last minutes of trading. And it is easy to understand how traders are becoming more and more concerned about lower and lower crude oil inventories, levels that are increasingly difficult to justify with current oil prices. This is especially true when there is no improvement in the Middle Eastern war situation. In fact, we saw several important escalations during this past week. One, especially, was the attack on an LNG gas tanker off the coast of Egypt, an attack that demonstrated Iran's capability to disrupt energy supply chains beyond the Middle East. There couldn't be better proof that sentiment towards oil is shifting than a recent Bloomberg report published at the end of the day on Friday, and disclosing that hedge funds added bullish crude oil bets at the fastest pace since March. The timing of the crude oil move did not surprise me at all, as Friday was the last trading day of July, coinciding with significant window dressing activity by asset managers, a window typically used to reposition their asset allocation for the months ahead. And we're seeing a clear shift towards a more bullish sentiment on crude oil prices, increasing the probability of a showdown between markets and those who have manipulated and crushed oil prices so far. Manipulating crude oil prices will be more challenging going forward, especially as strategic petroleum reserves increase. The US, they are now approaching the 300 million barrel threshold. Below that, the government might face challenges in draining oil while preserving the integrity of salt caverns. These crude oil releases have been critical tools to suppress prices, and their absence might cause significant and abrupt repricing in the market, as we experienced on Friday. All in all, developments are unfolding as have been predicted so far. Developments that I once again anticipated in my latest article for my premium subscribers on Slice Finance. Here is what I said in the very early hours of trading on Friday, when it was morning in Asia. We know the manipulation is going to break eventually, when human traders will panic and take over machines wired to ignore or downplay anything bullish for oil prices, and pick up trade anything bearish in what is one leg of the Trump trade. The other leg is long stocks, machines that have been greatly exploited so far by those coordinating the crude oil price manipulation efforts. In the same article, I highlighted what I believe will be the four moments that can trigger a significant market repricing, pushing oil prices to where they should have been trading for so long. That level is far above $100 a barrel for both WTI and Brent. The first potential trigger will be pushing oil inventories falling further, followed by the breaking news that the U.S. Gulf refinery declares force majeure. We will do this because they cannot meet contractual delivery agreement for distillates after the minimum operational levels are reached. The second moment will be a stop on U.S. SPR releases necessary to preserve the integrity of the solar powers. Third moment will be a major escalation in the Middle East beyond this week's surprise attack. A shift from Iran's proactive self-defense to offense will be a major escalation, but I believe the next major development will occur on the ground. News breaks about a ground operation on Kharg Island by the U.S., ground attack in Kuwait by Iranian proxies, Saudi proxies expanding ground operation in Yemen against the Houthis. I expect a sharp reaction in crude oil prices. The last potential trigger will be shortages in Europe and the US, likely starting with diesel, while I think shortages in Asia will still be ignored by the broader market. In the following week, anyone playing this oil trade must be very focused and attentive. Always remember, if you want to capture a move, you need to be positioned in advance. When something triggers, the algorithms will be so quick that you won't have time to place a trade. If you are interested in more premium content, trade ideas, to participate in my live streams and directly interact with me in the growing community chats, you can subscribe to my slides portal by clicking on the link in the description of this video. Alright, now let's talk about Japan and the Japanese yen crisis, which I again anticipated well in advance. 4 months ago, I wrote the article, Save Private Takaichi, How Japan's Yen Crisis is Being Ignored. Exactly anticipated all that is happening right now. First, why is Japan uniquely exposed to an oil shock? Japan is one of the most energy import-dependent major economies. An oil shock is not just a price move. It is an external tax Japan must pay in foreign currency. This translates into a current account channel flipping fast, as energy is a high pass-through input. The policy reaction function will be asymmetrical because the Bank of Japan is constrained, cannot comfortably hike rates to defend the currency without raising the government's interest burden. So Japan can face inflation pressure from oil while still not being able to tighten rates meaningfully. This is exactly what happened on Friday when the Bank of Japan did not hike rates again. The BOJ also said it will not slow down its purchase of Japanese government bonds, which forces them to continue printing new JPY, but helps the Bank of Japan to slow down the rise in Japanese government bond yields. Putting it all together, higher oil prices mechanically feed the JPY depreciation through 3 loops. The first is a terms of trade deterioration, weakening the trade balance and requiring more dollars. Second is imported inflation without the higher rate support to tame it. And the third is the risk sentiment and JPY carry trade dynamics. When oil spikes due to geopolitical factors, global risk premiums rise, increasing the cost of debt of countries like Japan that run large fiscal deficits. As a consequence, the JPY loses its safe haven bid, while shorting it to buy higher yielding assets remain attractive till interest rates in Japan to borrow JPY are not high enough. In order to slow down JPY depreciation, Japan continued strengthening traders with direct currency intervention. Trends that have been less and less effective because JPY depreciation is not driven by speculation as the government claims, but by market forces. On Thursday, Japan spent 8.45 trillion JPY, equivalent to $52 billion to force the JPY to appreciate. They sold US treasuries to repurchase JPY, but the effect of this intervention will always be short-lived, as I've been warning for years. Without structural changes in spending policies, the yen will resume depreciating no matter what, and we already saw that quickly happening after first the intervention. This is why it is not surprising to see the US Treasury stepping in to support Japan. Scott Bassett authorized selling euros from US Treasury accounts to buy JPY, strengthening. This was done during the most illiquid part of the trading hours on Friday for maximum effect. The US Treasury stepped up because Japan selling its treasuries reserves puts pressure on US yields. The US Treasuries is failing to control Treasury yields, not only because real inflation is much higher than nominal yields, despite the active use of the Treasury buyback program, but also because the US government deficit spending continues to widen, and the Fed is not going to hike rates to tighten financial conditions in alignment with the policy Trump wants Kevin Walsh to follow. This is the second big JPY intervention in the past few months, and I don't expect it to last. I believe the JPY will not only recover the 164 level it touched this week, it will go way beyond that under the pressure of rising oil prices, as I've explained earlier. These intervention attempts are completely futile because Japan needs draconian fiscal and monetary measures to deal with it. Until they stop printing JPY, everything will force the currency to depreciate no matter what. The final point I want to make in today's podcast on this topic is that these interventions must be constrained. If they trigger a volatility shock, like in the summer of 2024, a dangerous ripple effect in global markets will occur. Remember how in 2024, excessive and fast moves in the JPY caused by intervention caused the biggest daily drop in Japanese stocks of about 15%. They also caused the VIX to spike to 60 in pre-market trading in US on August the 5th, 2024, when everyone panicked and asked for emergency rate cuts from the Fed to handle the situation. I want to conclude today's podcast with a quick update about AI, because something important happened this week. That event was the implosion of one of the most successful hedge funds in the AI space. The blow-up of Situational Awareness LP, managed by Leopold Aschenbrenner, is a huge warning bell. It highlighted that excessive leverage was not constrained to just a few markets like Korea. The blowing up of leverage strategies is very typical of the bursting of a bubble. It's also typical to see the sharp bear market rallies like the one we experienced on Thursday. Stocks in that fund's portfolio purchased in a block trade by Citadel raised sharply. Some names like Corway or Nebius rallied 20 or 30% in that single day. That was a knee-jerk move by traders who didn't want to keep short position in place against Citadel. On the same day, Microsoft rallied 14%, adding over $500 billion in market cap. Many people thought this confirmed supportive sentiment for AI stocks remained in place. But I want to highlight that similar moves in Microsoft shares only happened 3 times before. These were in October 1987, October 2000, and October 2008. In all three circumstances, we were in the process of a burst of a big financial market bubble. Thanks for listening to my update today and for subscribing to my premium content on Slice Finance. Thanks for supporting me on X and for reading my research on justdario.com. I wish everyone a nice Sunday. Bye.